Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxBox. My guest today is Kim Clausing, Deputy Assistant Secretary of the Treasury for Tax Analysis. Before joining the Treasury, Kim was a professor of tax law at UCLA, and before that at Reed College. She's the author of Open, the Progressive Case for Free Trade, Immigration, and Global Capital, as well as many articles on corporate and international taxation, including some with my colleagues here at TPC. Kim is our first repeat guest at The Prescription. Before we begin, just a bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event's being recorded and will be posted online on TPC's website. We're using captioning, which you can adjust or turn off with a live transcript button at the bottom of your Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Kim Clausing, welcome to The Prescription. Welcome back to The Prescription.
Thank you so much for having me. It's a real pleasure to be here.
Great to see you again. President Biden's proposed an ambitious tax agenda, including big tax cuts for families with children and large tax increases for high-income households and corporations. The president justifies these changes in two ways. First, tax fairness, and second is a way to finance spending to boost economic growth. But fairness and efficiency are often at odds, so help me understand how they fit together in the president's agenda.
Yes, thank you. That's a great question. And I think one thing you'll notice if you look at these tax proposals, and I know the Tax Policy Center has done some analysis, is it's one of the most progressive tax changes really ever proposed. It's a very progressive package. But beyond fairness, I would also hold that there are a lot of elements of this proposal that also have their eye really focused on efficiency. For instance, if you look at the corporate tax, right? Textbook treatments of the corporate tax back, when we studied it the first time, treats it as if it were a tax on the normal return to capital. But we know that there are a lot of features of today's corporate tax base that make it almost entirely falling on excess returns or rents, right? For one thing, in current tax law, expensing is allowed for equipment. But even beyond that, if you go back in time to 2013 analysis, done by some economists actually at Treasury, they had already concluded that 3/4 of the corporate tax base was excess above normal returns to profit. So that's one way in which we could think of those tax increases as being efficient. But you could also imagine the green subsidies that are part of the American Jobs Plan as responding to Pigouvian externalities. So by subsidizing something that's good, that's helpful there. Some of the tax measures that help those at the bottom of the income distribution also encourage work, like the expansion of the earned income tax credit and the expansion of the child independent tax credit, right? So we think those might be efficiency enhancing. And of course, some of the tax increases on those at the top are also falling on excess profits. So think about, for instance, the proposal to get rid of the step up in basis. A lot of people accumulate vast amounts of wealth that go entirely untaxed by the capital gains tax system because they get step up in basis at the end of life, right? So that's one way that we can sort of reach some of these, extra revenues without creating a huge inefficiency cost.
So TPC has released its analysis, and as you say, we found that it was your proposals are extremely progressive. But we also concluded that the president's tax proposals won't entirely exclude from tax increases every single household that makes less than $400,000, which was something he promised during the campaign. Even if you look only at individual income and payroll taxes and exclude the effects of corporate taxes, some households making less than $400,000 would pay more. Is that acceptable to the president, or will you revise the plan to actually protect everybody below the threshold?
Yeah, so I think there's two components to that question. One really pertains to the corporate tax incidence question, and the other pertains to the individual. So let's take those one at a time. On the individual side, I believe that your finding comes from this unrealized gains part of the proposal, right? And so it partly depends on your perspective of who's really bearing the incidence of that, right? So if we think of this as falling on on the decedent, in the year that they realized those unrealized gains, they had, over $1 million of unrealized gains, or they wouldn't have been affected by the proposal, right? So I know that the Tax Policy Center and Treasury don't have the exact same way of looking at that issue. I believe that came up under a prior administration as well. But in some very realistic ways of considering who pays the incidence of the tax on the income that was earned, in fact, by the decedent, I think there are interpretations of that are fully consistent with the pledge. In terms of the corporate tax incidence question, there's a few things we know here, right? Every major organization, including Tax Policy Center, American Enterprise Institute, Joint Committee, Treasury, they put the lion's share of the incidence of this tax on either capital or supernormal returns, right? And so we know that to be true. We know that almost every other tax in our tax system falls almost entirely on labor, right? Including personal income taxes and payroll taxes, right? And we also know that, many of the decisions about how to distribute that incidence were, undertaken some time ago, and that market power is an increasing feature of our economy. There's a lot of evidence that market power is larger than it has been in recent years. We know that the empirical work has shown very little correlation between corporate tax changes and wage changes, right? Which is the mechanism through which we might think some of this could fall on labor. And if you look at the past experience of countries like Germany and the UK and Italy and Japan and our own experience, right? You see very little benefit to workers from corporate tax cuts. In fact, I can't find any when I look at the experience of those big countries, right? So I think, there are differences of opinion on the exact incidence here, but when you look at the empirical work and the experience of recent countries, I find it hard to argue that the corporate tax isn't really predominantly borne by, capital and excess returns. And the types that, even if you do look at the models that assign a little bit to labor, we're not talking about a substantial tax increase, right? These are usually very small amounts.
We could probably spend the whole half hour talking about incidence of corporate tax, but we won't.
Yes, we could. Yeah.
Senator Romney and others are hinting that they could pay for an infrastructure bill without raising taxes. Leaving the math aside for a minute, it raises an important question. Does the administration favor tax increases on corporations and high-income households merely as revenue raisers, or do you believe that raising these taxes for their own sake to reduce income inequality?
I think that the argument for this set of tax increases is really multifaceted. Of course, revenue is really important. And when you look at federal revenue relative to GDP, the United States only raises right now about 16% of federal revenue relative to GDP. And that's just not really a sustainable amount of revenue for the kinds of things that we want to do. So of course, that's an important objective. But as you point out, there are other reasons to think that these are good tax policies all by themselves, right? We've experienced a period in the United States where a lot of the extra GDP growth and a lot of the prosperity has really fallen in the hands of a relatively smaller slice of the population than would be desirable, whereas wage growth and prosperity in the bottom half of the distribution has definitely lagged behind expectations. Right. So if you look at this set of tax policies, their progressivity, I think, is by design to sort of say, OK, we do need more revenue to fund the state, but it's reasonable to ask, people to pay, a little bit more at the top. And we're not talking about expropriation here. These are very reasonable tax rates, and often they're done by expanding the base as well as thinking about rate increases. So if we think about changing the step up in basis, that's one way of expanding the capital income tax base. And when we think about the international provisions on the corporate side, that's one way of expanding the tax base there too. We're not suggesting going back to a 35% corporate rate, but we are suggesting going somewhat higher and then protecting the tax base from erosion by focusing on these international features. So we view this as sort of like revenue, but efficiency and equity are all served by this combination of policies. And so it's not a unidimensional case, but rather a multidimensional one.
So all that said, would the administration consider other revenue sources such as user fees, motor fuels taxes, or excise taxes?
Well, the administration is committed, as you know, not to raise taxes on families who fall below the 400, and households and taxpayers who fall below the 400,000 line threshold. So many of those user fees solutions would, presumably be borne by those groups, right? So, our focus is on finding tax revenues that are consistent with that, commitment. And I believe that the president's proposals really do raise a substantial amount of revenue such that we won't really need to turn to those types of solutions, which, it's possible that future administrations would consider. But right now, in this time of great income inequality, it seems important to sort of try to be more progressive in how we're raising the tax revenue.
So that sounds like a no.
That's a no. Yeah.
That's a no. Okay.
Yeah. I didn't realize you wanted the one word answer, but yeah.
Save a little time, get a few more questions in. You proposed, as you mentioned, taxing unrealized capital gains at death. Tell me a little bit about why this is a better option than other solutions, such as annual accrual taxation of gains or a wealth tax, or shifting to carryover basis for estates and gifts.
Yes. So, this area, like many, there are compromises that have to be made or that are often, thought of. One of the nice things about this proposal, I think, is it changes, over time, the lockout effect associated with raising capital gains and dividends rates, right? So we might be concerned that if we just, for instance, went to a proposal where all we did was raise the capital gains and dividends tax rates such that we're treating wealth like work on an ongoing basis, there's be this incredible incentive to just hold the asset until you pass, and then you don't ever have to pay the capital gains tax. So this proposal is targeted directly at that problem. As you point out, mark to market is another really great way to address that problem, right? Because then you're taxing it constantly as it's being earned. You're not waiting for this other event to happen that triggers the taxation and the realization. I think that's something that really should be studied, and is being studied, I know Senator Wyden has a proposal, and many academics have thought about this. Most people think that if we're aiming to legislate immediately, that there are aspects of that proposal that aren't quite ready for prime time. So for instance, there are some really tricky issues surrounding valuation and liquidity that you'd want to treat with a lot of care and attention. And so I think, one of our focuses was on what can we propose that's really kind of ready to go and that doesn't necessarily need, years of careful design and implementation work, which doesn't mean that some of these longer term solutions aren't attractive.
So let me ask you about something the president didn't propose. So in the campaign, he talked about repealing all of the TCJA's tax cuts for high-income households, including the special 20% deduction for pass-through businesses, so-called 199A. But he left that out of his budget. Can you tell us a little bit about why?
Yeah, so the 199A treatment would, in the view of many economists and observers, is something that, isn't necessarily like a desirable feature of tax law. It's widely recognized to be inefficient in sort of distorting resources across industries. It's quite complex, and it's not very equitable, right? The benefits from that really accrue to those at the very top. The administration was eager to get out a package of proposals, and it put forward the best set of proposals to meet the revenue needs of the American Jobs Plan and the American Families Plan. Things that were excluded from those packages aren't necessarily things that were out and out rejected as bad tax policy. In many instances, there were things that people wanted to think about more or design more carefully. There's some important phase outs and expiration dates coming down the road that one might want to think about more holistically. So I wouldn't view the American Jobs Plan and the American Families Plan tax proposals as sort of the last thing that Biden administration will ever do on tax, right? It's kind of an opening. It's like, this is what we could do in 100 days with confidence, with adequately studying the issues and with raising the amount of revenue that we thought was appropriate for the kinds of spending proposals that are also in those plans. So I wouldn't read too much into absence as sort of saying that, if something's not on the list, that it was unequivocally rejected, because that's not necessarily the case.
So presumably, if this were added on the Hill, the administration wouldn't object.
I'm sure the administration has said many times that we're very eager to work with the Hill and to hear their thoughts on revenue raisers here. And this is another area where we're definitely very eager to work with them.
So we shouldn't read this as saying you're just going to just wait and let this expire in 2025. That there may be some interim steps between now and then.
Yeah, like I said, I wouldn't say that the American Jobs Plan and the American Families Plan are the only tax proposals you'll see out of Biden between now and 2025. That would surprise me very much. This is the effort of a lot of people working very hard for 100 days. This isn't the final effort.
The president, of course, has also proposed a minimum tax on book income, which would be a very interesting change. Yesterday, TPC and University of North Carolina had a conference, and some of the panelists worried that companies would just manipulate book income or even restructure themselves to avoid the tax, since it applies only to corporations with pre-tax net income of $2 billion or more. Is that a concern, and are there ways to prevent that sort of manipulation?
I would say that a couple things about the design of that tax. It was very much an intentional move to restrict it to the largest companies in the economy, and it falls on fewer than 200 companies. Depending on the year, the number can bounce around a bit. And why focus on the largest companies? You might say, why not hit the smaller ones as well? We were very much concerned with some of the market power implications of the biggest companies, but also with the fact that, if a company really is reporting to their shareholders more than $2 billion, that's very different from then, maybe in one year they report 100 million or something, from some of these smaller numbers. They're really sort of saying to their shareholders, hey, listen, we're making billions, plural, of profit, but yet they're telling the IRS that they're not making any. So that sort of discrepancy was the part that we wanted to focus on. A second design feature that I think is really relevant here was we were very careful to sort of not set up a system where the government's handing a company money with one hand and taking it away from another. So there's some things like R&D and clean energy credits, for instance, which the US government has, for legitimate reasons, decided to encourage through the tax system. And we wouldn't want companies that were benefiting from those provisions to then run afoul of the minimum tax. So we also designed it to carve that out. That said, I think that I would view this as a more minor proposal than many of the other things that we're doing in the corporate space. I mean, this is a backstop to some of the international provisions. But I think the international provisions are really a very direct way to get at the more widespread phenomena that many companies earn a lot of money without paying a lot of tax. And that's true in a more systematic way in the international realm, right? Because the income gets shifted off into these very low tax jurisdictions, and so our international plans are laser-like focused on that.
Okay. It is interesting because one of the panelists mentioned yesterday that we tried something like this with the corporate AMT in the 1986 tax reform, and apparently companies, in fact, did respond by under-reporting book income. So if past experience is any indicator of the president, perhaps that is going to be a problem. Yeah,
advocates for this kind of tax would notice that there's sort of conflicting objectives that companies have, right? They want to tell their shareholders the best possible thing, and they want to tell the IRS the worst possible thing. And so one way you could view this instrument is an attempt to sort of better align these incentives. That said, I know that there are a lot of concerns about politicizing the accounting tax base. And I do view this as, a more indirect and backstop type of approach, that hopefully, would be less necessary as you fix other parts of the tax system, such as the international rules, or if there's some things that are persistently driving people into book tax liability, you might think about what is this telling us as policymakers? Do we really approve of these provisions and they're accidentally befalling these firms, or these provisions themselves things we should rethink? So I think that's a conversation that should be ongoing.
I want to ask you about this backup, but first let's talk a little bit about the second minimum tax, which is the international one. And of course, Secretary Yellen got a lot of attention the other day. She seems to have successfully convinced the G7 to support the idea of a country by country minimum tax, at least in concept. Can you give us a sense, Kim, of sort of what we should expect this process to look like? And I'm almost thinking about on a scale of 1 to 10, where 1 is the starting line and 10 is the finish line. Where are we in this process?
Yeah, I think we're in pretty good shape in this process. And I would point out that there's sort of two complementary tracks on which this process is moving. One concerns domestic legislation, and there's a lot that the United States can do all by itself to address problems associated with profit shifting and offshoring and the race to the bottom in corporate tax. But it's also very helpful at this moment in time that we have this very large ongoing multilateral negotiation that involves over 130 countries, not just the G7, but the G20, the OECD, and the inclusive framework countries, where, the world community has determined that, this problem associated with the race to the bottom in corporate taxation is a serious problem that should be taken seriously. So if you look at the Biden administration proposal to move to a country by country minimum tax, and you look at the OECD Pillar 2 proposal, you'll notice a lot of very strong thematic similarities. And why that's such a nice time to do international tax reform in the US is it basically takes away one of the major objections to solving this problem more unilaterally, right? So if you think about solving this problem unilaterally, you would say, okay, well, we have a situation, which is true, where we give a 50% discount to the vast majority of foreign income relative to domestic income. And some of the foreign income we don't tax at all, the first 10% return on assets, right? And so this is a big tilt in the playing field to doing things abroad rather than doing them in the United States. And so and in fact, the non-country by country version of our current minimum tax creates this perverse kind of America last feature where you'd actually rather do things in Japan and Germany than in the United States, because you would generate credits that would offset the minimum tax due on income from very low tax jurisdictions, right? So reforming that is very desirable because it seems odd for our tax system to, be prejudiced in favor of doing things abroad relative to doing things at home. Now, when you suggest reforms to this, which people have, and I have in the past, even before this job, you get the argument, well, if we do this in the United States and other countries don't do this, then our companies are going to be really disadvantaged in these, global merger and acquisition markets, right? Like, so let's say a US multinational is competing with a French multinational over a Singapore project, right? You might worry that the US multinational would be at a disadvantage relative to the French one if we did this and France didn't, right? And so also encouraging other countries to solve this problem and to come to the table and to negotiate a coordinated adoption of a minimum tax really eliminates or substantially reduces that concern. Because right now, the global agreement is zero, right? We don't have a global agreement, right? So even if we got it up, not quite to where the US is, but a lot closer, right, we'd be massively lowering that differential. So when we think about the differentials here, there's more than one that's relevant. There's the one like the US company competing against the foreign one. That one's going to get a lot smaller, but there's also the US location versus the foreign location, and that one's going to get a lot smaller. So when we think about the Biden proposals, it's an attempt to lower that US versus foreign location differential, but the global agreement also lowers this other US versus foreign multinational. And I think differential. And I think that that's just a really useful thing to have at this moment in time in the world economy, because a lot of middle-class people, not just in the United States, but throughout the world, have really turned to sort of nationalistic and populist solutions to the fact that it feels like the global economy really isn't working for them. And one of the ways in which the global economy really isn't working for them is that the tax burdens of countries that countries put on their citizens throughout the world really aren't very effective at reaching capital. They're quite good at getting at labor or consumption, those are easy to find. But if capital is like quickly and agilely moving to the lightest tax jurisdictions, then it's really hard to have a fair tax system. And if you can't have a fair tax system, it's really hard to share the fruits of our really vibrant global economy in a fair way, and to raise money that's needed for things like public health and infrastructure and education and all the goodies that people like.
So a lot of lawyers and economists who we both know well argue that they go even further, right? They say that the corporate tax today is just obsolete. That in a modern economy, you've got to have some sort of a destination-based tax. And the idea of trying to tax firms based on their headquarters or where they produce goods is just futile. So the G7 seems to acknowledge this, at least in a small way, but is that ultimately the direction that international tax is going to go? We're going to go from this current corporate tax system to some sort of a destination-based system. Is that where we're going to end up?
Yeah. So let me address like two parts of this. First, this idea that the corporate tax itself is obsolete, I think is partly that idea is partly an outcome of the fact that we haven't been very good at solving this particular problem, right? But I would point out to everyone watching that it's not possible to just seamlessly shift the burden onto individuals, which some people have suggested, because in the US case, for instance, 70% of US equity income is entirely untaxed by the US government. And the paper that you referred to that I wrote with TPC colleagues shows that fact. So that does imply that you need a corporate tax. Now, whether it should be based on destination or headquarters, I'm a little bit agnostic. I've written in my academic life in favor of both. I think part of the problem with the destination solutions in terms of immediate implementation is that they aren't ready for immediate implementation. So if you move to a destination-based cash flow tax, or if you move to a formulary apportionment system, and there are elements, as you know, in Pillar 1 that have formulary aspects, those are very complicated and vexing transitions, right? So while it might be very intellectually appealing, to go in some of those directions, it's definitely not ready to happen immediately. Whereas we do need some tax policy that's capable of really responding to this moment in history. And it's true that, taxing based on headquarters location does create some pressure on that. But there are very useful tools that you can use to counter that pressure, including both anti-inversion measures, but also the administration has proposed something called the shield. And what the shield does is it basically says, okay, if you're headquartered in a country, if your company is based in a country that doesn't have a robust minimum tax, then the shield will disallow deductions to related parties in low tax countries. And it's a very useful instrument for not just encouraging countries to participate in this minimum tax negotiation, because they have a strong incentive, but it's also very useful for relieving the pressure on headquarters, right? Because now whenever you're in the US market, you're either from a country with a robust minimum tax or you're getting this shield treatment, which will prevent income stripping out of the US base. So we do have tools to address this concern.
We just got a couple of minutes left. Let me switch gears and just ask you about another proposal that I know you've been very engaged in, and that's this whole issue of closing the tax gap. And one of the administration proposals would require financial institutions to report deposits and withdrawals for all account holders. One of the criticisms of that, even among people who support what you're trying to do, is that it's going to inundate the IRS with information on people for whom it's just not going to make much difference. Former Commissioner Rosati suggested limiting this to the highest income 25% of filers. Is that an idea that makes sense? Is that someplace the administration could go?
I think that limiting this to a subset of taxpayers is problematic for a couple of reasons. One, you've got privacy concerns, because then the IRS is telling all the financial institutions a subset of taxpayers to pick on based on IRS information that really the other people shouldn't have access to. So under our proposal, all the information goes in one direction, into the IRS, but not out of the IRS. Another problem is that we don't necessarily know people's true income based on their tax filings. And that's in fact why you need, a compliance proposal. So someone might say they earn $70,000, but they might have millions of dollars flowing through their account. right? So those people, we would want to be able to catch the evasion behavior in part by looking at that mismatch between their reported income and their financial reporting. But if we went with the Rosati proposal, we wouldn't even get the information because we'd say, well, they look like they only earn 70,000. Right. And we all know of prominent instances where, wealthy business people show losses year after year, despite potentially having a lot of taxable earnings. And so I think having a lens into these opaque sources of income is a really important innovation. And there are really sensible ways to do that. And there was a nice op-ed just yesterday in the New York Times by 5 former Treasury secretaries, and I know the current one also supports this, suggesting that greater financial reporting would be very helpful in this area.
Great. Well, Kim, it's always great to talk to you. We're out of time. Good to see you. Good luck with your work at Treasury, and thanks to you and thanks to our guests. Take care.
Thank you very much.